This is Xenium.Live, where we talk all things money, finance, and property. I'm your host, Scotty North. And today, we're a bit delayed. Sorry about that for those that have been waiting patiently for us to get back on air. It's just the 2021 thing. We're just thankful it's actually 2021. It's not still a continuation of 2020. But if I was really honest, I'd just blame today's guest for our delay. PJ Patterson, welcome to 2021, and thanks for being late.
Mate, no problem. I will take full responsibility for being late. I was actually in the backyard blowing bubbles, and I just got carried away chasing them around the yard and stuff, and totally forgot that we had a show today. So I do apologize. You can lay all the blame at my feet. So let's crack on.
That's good. That's good. And they reckon us Queenslanders are behind the times, but we won't focus on that for just now. So look, we have talked about today's show quite a bit coming up to this, because we're saying, okay, we really need something to kick off, almost not the theme for the year, but definitely a real tangent of where things are going, right? Like a real rush of what's going on. And you said, well, look, there's a bubble happening. And one of us said, well, we should probably embrace it. And that was how it came about today. So, mate, what's happening? I mean, last time we chatted was sometime in December, I think, early December. And there's probably quite a bit that's happened through that. But where's your forecast for the year for financial markets? And why are we talking about embracing a bubble?
Sure. So bubbles everywhere. We are actually in, and I know some of the language that I've used on these shows of late is talking about the quadrant model and the quads that we're in. So we're actually in quad 2 at the moment, economically, global macroeconomically. We're in quad 2, which is a great quad to be in because it is the reflation quad. And it usually follows a quad 3 or quad 4 scenario, which is one of those nasty ones where you get stagflation and deflation. And of course, we had a lot of that last year with the COVID situation, which unfolded, economy shut down around the world. And of course, the response from central banks, and of course, I'm outside the Fed today, blowing bubbles on their front lawn here. They're the masters at blowing asset bubbles. And the way they do this is they print a lot of money. They buy a lot of bonds. They work in concert with the government to ensure that the government can deficit spend into oblivion and give helicopter money to people and support programs and do all of this stuff, which pushes a lot of economic firepower out into the economy via the banking system, and then eventually, hopefully, straight to the individual. So this is how a central bank effectively blows an asset bubble. And I'll just hearken you back to the Greenspan. So some of you might remember a central banker with the last name of Greenspan, Alan Greenspan, back in the 90s and early 2000s, who was one of the first maestros at blowing bubbles. Now, he is credited with certainly blowing the real estate bubble, which ensued in the early 2000s, which Bernanke inherited that crisis when it blew up, because this was all the subprime stuff and all the ninja loans. And, I think most of your listeners and people that you've dealt with probably, lived through some of that stuff, particularly in Australia. But that was an example of an extreme bubble that got blown up. It started in the housing market, and then it went out from there. And then we had Bernanke, who inherited that mess. We had a crash in the housing market in the U.S. and a crash in the stock markets. And of course, they went back to the old playbook, which was take interest rates from whatever they were at that stage, maybe 5-6%, take them down to 1 or 2%. And again, do what I just described earlier, which is try to get as much capacity back out in the economy so that we have a reflation, or really you could call it an inflation, but it's a reflation of the previous asset bubbles. And that's exactly where we are today, and exactly what's happening right now is we've just had this crisis, this COVID crisis, which shrunk the global economy, no doubt. GDP figures were negative, spending was negative, everything was negative. It was just a really, if it's okay for me to use the word, but a really pooey, shitty time, right? It was very negative out there. And we've kind of gotten over that. And off the back of all the government spending, the central bank buying bonds and juicing the money supply. I mean, interest rates in Australia are 0.1%. That's the cash rate. It's just ridiculous. They've never, ever been this low. We're now starting to see the effects of all of that activity that they did last year in the middle and latter part of 2020. And we're now starting to see that flowing through in better GDP numbers, and we had a pretty good print yesterday. I believe they announced GDP, and it was still negative for the quarter, but positive for the year. So I think it was up about 8% year on year, but it was negative 1% for the quarter on quarter comparison. But next quarter and the next year over year number should be a huge number for Australia. So anyway, what this means for all those punters out there is we're going to continue to see a massive amount of asset inflation in Australia and globally. That's what a bubble is. And knowing that, you should do whatever you can to participate in it while it's being inflated. So that was a real, that was a bit of a summary and a synopsis of bubbles, I suppose, but it gives you a bit of insight and I suppose grounding into what is a bubble and why you have to recognize them and why you actually have to embrace them, because you make a ton of money during the reflation phase.
Well, I mean, that's a good point. So everyone is going to want to embrace a bubble or, be part of it. But how do you, firstly, there's two parts to this question. How do you actually participate well in a bubble? And how do you get out before the bubble bursts, right? That's what everyone's going to want to know.
Of course. So best way to participate in a bubble is to identify the asset classes that typically reflate and do very well in a bubble scenario. Now, the first asset class that does really well in this scenario are commodities. So, luckily Australia has a lot of that stuff in the ground. I'm talking about all form of commodities, all the way from energy to metals to base metals to agriculture, all of that. All of those things will reflate. Now, interestingly, a lot of people don't appreciate or understand even how to invest in that sort of thing. Now, luckily, Australia's stock market and economy is heavily skewed towards both agriculture as well as the base metals. I mean, we are very well known as being a mining and agriculture country. That's what we produce. So it's no surprise that Australia is really moving quickly to recover from the economic malaise of last year, and will continue to do so. So one of the best things you can do is just buy the ASX 200. Now, of course, you could be a little bit more surgical and own some of the miners. And I'm not talking gold miners. I'm talking base metal miners, your BHPs, Rios, Fortescue, some of those guys, copper miners. And unfortunately, the horse is kind of already halfway out of the barn on this one, maybe even a little bit further, but there's still time that you could do that. You could buy that and own it. The second thing to own would be, of course, real estate. So because interest rates are so low, one of the benefactors of a low interest rate environment is going to be real estate. And we're already seeing and hearing the stories of, people paying ridiculous amounts of money over, auction reserve prices and all this sort of stuff going on. We know that there was a big stimulus package that was put forward for housing not late last year, but during the COVID crisis. The government really wanted to support the housing industry and construction property industry. And so, again, we're seeing those things coming through in the housing market. So those would probably be the two biggest benefactors. And it's probably worth mentioning some things to stay away from as well. So the things you actually want to stay away from during a reflation. And by the way, eventually interest rates start to rise. Now, we'll probably get to this topic in a moment, but interest rates have already begun to creep up. We can talk about that in a bit more detail in a moment. But one of the things you should stay away from during a reflation are government bonds. That is one of the worst places to be. Utility companies, things like that, things that are eventually going to be very sensitive or are sensitive to inflation rising and to interest rates rising. You don't want to own that stuff.
Okay. All right. So we will touch on the interest rates shortly. So we're talking
You had a second part to your question, which I should touch on, which is when will we see that it's time to get out?
Yes.
Right? Because that's a key one. Yeah. That's a very, very important question. It's really going to be, and again, I use the quadrant methodology or system to identify what quadrant we're going into. So what we're going to be looking for is, first of all, we're going to have a peak in GDP in the second to third quarter of 2021. Now, what that means is, at the moment, the forecast for GDPs pretty much in every G20 country are the highest level of GDP since World War II. And certainly in the United States, this is absolutely the case. So it's been, 8 80, let's say something like 60, 70 years since we've seen GDP figures this high. And so it's kind of a once in a lifetime kind of event. And what's then going to happen is that that's going to peak, and then it has nowhere to go but down. So then we'll start to see the economy cooling off, GDP start to come back down. And that will be a sign that we've gone through what's called, in my vernacular, a phase transition from one quad, which is quad 2, probably into quad 3, or possibly even quad 4. And that's because it's not necessarily that the economy is going to shit itself again. It's just that we will have had this massive run up in the recovery, the whole recovery from COVID, and things will normalize effectively. And so we'll get that big run up, that big juice, that big reflation, and then we're probably back to, whatever normal is for the next few quarters. And that's due to happen in quarter 3 or quarter 4 of this year. So back half of 2021.
Okay. So just correct me, I'm just making notes here. Quarter 4, quarter 3. So what I'm trying to understand in layman's terms is what we're seeing is because we dropped so much as a percentage, our next run up, even if we only go back to normal, it's considered a large run up. So we're just going to sort of get back to normal, and it could possibly sit there or, carry on, or maybe go a little bit further. But it's that run up that we're wanting to be a part of. That's right?
Yes, correct. You want to take advantage of the reflation. So again, the stock market's going to be the easiest way to do that because it provides liquidity and a lot of different options to invest. And that's more of a shorter term thing where you can be a bit more maneuverable, where you can change the style of investment you own to suit the quadrant that we're going into and coming out of. So that's probably my preferred method. But if you're a bit more of a long-term, investor, you can certainly be looking to create some real value in real estate probably over the next year or so. But bearing in mind that interest rates are going to start to rise again, they're going to have to. And we've actually seen this already begin to occur. In Australia, we had I think it was last week at some point, we had a huge jump in the 10-year bond yield in Australia, went up something like 17 basis points, which is a ridiculously large move in interest rates. So what's happening is the bond market, and this is occurring, I should say, it's occurring in the U.S., in Europe, in many developed economies around the world. And the issue is that the bond market is sniffing out that we have inflation coming down the pike, and so it's adjusting itself. So interest rates are going to start to rise, and at some point, the central banks are going to have to react to the reported inflation figures. Or the inflation figures that get reported, I should say, and may very well have to increase interest rates at the cash rate level. When that happens, I don't know. Whether the RBA will do it, I don't know. It's just that's too far out into the future to really know for sure, but it will eventually happen.
All right. So if we're looking at stages of what's going on, so we've had gone down last year, we're seeing things go back, back up, even if they go back to pre-COVID normal levels of transaction and activity in the markets. There's that run on the way up. If it just stabilizes out at sort of pre-COVID levels, that's not necessarily a bad thing, right? It just means you've had a run up, you can capitalize on that now, but that's not necessarily a bubble crash if it stabilizes out. So at what point would be an indicator for a bubble crash after that?
Well, again, I think what we have to really be looking at is the economic data. What is the data doing? What is the data telling us? So unfortunately, I can't really give you an answer to that question until we get another 3 to 4 to 5 months of data and activity happening. So it's a little bit like.
So what would we be looking for, though?
What would we be looking for?
Because you're always looking for stuff, right?
Okay, so I got it. Good question. So what we're going to be looking for are slowing corporate earnings, probably rising wages and lower profit margins in companies, things that are suggestive that the cycle is turning again. And I'm talking about the business cycle. So right now we're seeing margin expansion because it's off low base effects, low comparisons from previous quarters. We're seeing wage rises. We're seeing obviously people getting back to work and all the rest of it. So those are some of the things to be looking for. So specifically, one thing to be looking for would be earnings in certain sectors of the market. So like things like retail, services, probably mining and energy and so forth, beginning to decline. And of course, interest rates rising across the board too. That's going to be a problem. So those two things I would be certainly looking for.
Yeah, no, that's good. All right, so just once again, we've got the run up now. We're going to hit sort of a top out at some point, whether it's pre-COVID levels or a little bit beyond that. And then we need to look out for those corporate earnings and the profit margin and the interest rates going forward, and to watch that to see what happens when the bubble may burst.
That's right. And look, it may not be a bursting of a bubble, like that. That's a pretty extreme example. It could just be a deflation of the bubble. Central bankers typically aren't great at deflating bubbles slowly. They say they try to prick the balloon and let the air out slowly. But look, monetary policy is a tricky animal, and it's really hard to know how to get the settings right. And of course, it's a very slow moving animal as well. So the market will throw up plenty of signals. And again, we'll continue to have these discussions throughout the year. I think I'll probably be telling you when it's time to head into the bomb shelter and get ready for the bubble to burst. But it's definitely not any time in the next few months.
Well, that's good, because I thought that might be what happened before today's show. I'm like, well, PJ's disappeared. He's in the bomb shelter. I can't find him anywhere.
The bubble burst.
The bubble is gone. Look, I wanted to touch on something that you said before in the let's get this to work here on my screen, and which is the real estate side of things, right?
Mm-hmm.
Where are we? Here we go. All right, so this was an article that came out this week, and of course, it's sensationalizing, whatever. But buyers are confronting a sense of fear of missing out. Aussie property prices rise at the fastest in 17 years. It was pretty much 18 years if you actually looked at the data in the thing. And it reminds me, because I've been saying to everyone, this reminds me of the time back in the early 2000s where, we saw this sort of stuff happening in the property market. And on the Sunshine Coast, where our bomb shelter is located, PJ, it is, we'd see this sort of thing, and people, and I'm going to dig him up for one of our next discussions. And I actually back then used to cut out newspaper articles. Remember what a newspaper was, PJ? Remember when they used to print them?
Vaguely, yes, I remember.
Yeah, and I had them in a big scrapbook, and it was things like, there's 1,500 people a week moving from south to Queensland, and people can't find rentals, and people, all this sort of stuff. And I'm like, this is exactly the same rhetoric that's going on right now. And this article goes on just to talk about that, and sort of that this is the cycle repeating. Now, this isn't a property show, this one. I mean, we always talk about it, but we will delve into this specifically on a property show and show some real examples. But what you're saying is absolutely correct. The benefactor of some of these policies on interest rates or monetary policy is definitely going to be real estate. I mean, some of these prices we're seeing and some of the activities at the moment are absolutely crazy. I mean, I don't know if I've seen, well, I haven't seen anything like it since, as this article says, since the early 2000s. How about you?
I don't, to be fair, I don't really pay too much attention to those metrics anymore, but I do see the headlines. And of course, that's an interesting thing that they've described it as FOMO, because that's what happens. And that's one of the things that drives bubbles is FOMO. People start to see the train leaving the station, and they get very afraid of missing out on that. So they will just then, dive for the train, try to jump on it any way they can. And that's what precipitates and perpetuates the bubble. And of course, it's a little bit of a game of musical chairs as well. And that can go on for a very long time. I remember famously, Steve Keen, I believe was his name, who was an economist who was, making the bet about climbing Mount Kosciuszko or whatever. I forget who the other economist was, but, was saying the market was going to crash by like 40%. Now, it's funny that economists, typically have no idea about the economy, because he was dead wrong on that, number one. And of course, the market didn't crash. It's never crashed. There's always going to be corrections along the way. And what I would argue is it's going to pay attention to interest rates. That's one of the key things to pay attention to is interest rates, because I tell you what, as long as the money is this cheap, people will be able to go and overbid for properties and pay, through the nose for them. It'd be interesting to see what the average person on the street, so somebody who's buying a property of, say, I don't know, let's say 650 or less, that's a different demographic of person. And I just wonder what their economic metrics look like. I suspect that a lot of this activity and this FOMO is probably at the higher end of the property market, so that 1 million plus. But I don't know.
Well, it can be anywhere. It depends on the location in the country, and it depends on a whole bunch of other things. I did a chat with Terry Ryder a couple of weeks ago, and he was talking about how interest rates, like you are, is one of the things driving this, but there's people migrating and moving around and getting out of cities and other bits and pieces. But just while we've got this article up here, I wanted to touch on, I don't know, where can I make it? No, maybe, can I move this one? No. All right, so this here, can you see this article down the right-hand side? There's a little, one of these top stories, clickbait things.
Oh,
Gold
yeah.
Coast shop sells bottle of whiskey for almost $10,000. Like that's kind of like funny, haha, yeah, it's good on them. But that's the type of thing that we see happening in these stages of the cycle, right? Like these crazy prices we talked about last year on used cars. New cars have a 3 to 6 to 10 month wait. Bottles of whiskey for $10,000. I mean, this is the sort of weird stuff that goes on at this time because it's like this almost feeding frenzy of activity that people want to get involved with.
Oh, yeah. And one of the things, I mean, I think the used car market last year went up simply because of the fact that the borders were closed and you couldn't import new vehicles. And I know that was one of the driving factors behind. And it's, we're not talking about 15-year-old bombs here. We're talking about, probably 3 and 4-year-old used cars that are effectively still new cars. They were getting price rises as opposed to the typical, depreciation and price falls in those. I'm sure that market is readjusted by now. Who knows for sure. But yeah, one of the things during bubble manias to look at are things like the fine art auctions, the Sotheby's and Christie's auctions. If people are just paying stupid money for artwork, for New York City apartments, for, whatever, that's a true sign of a hyper sort of bubble. We're nowhere near that though at the moment. I mean, $10,000 for a bottle of whiskey, any jackass out there, who thinks they're wealthy can go buy a $10,000 bottle of whiskey. It's when they buy that, $200,000 bottle of Year of the Comet whiskey or something like that. That's when that something is amiss out in the markets.
I thought whiskey was like $23 a bottle, mate. I'm a bit out of it. But we got a couple of questions come in here. Let's have a look here. We got the first one, which we kind of touched a little bit on here. Any idea how long this bubble will last for? When we get out, what's the predicted timeline? And on that question, there's another one that's similar. Sonia's dropped by, and she says, so should we buy a property or not? When will it be the right time and preferable suburb? So that's a baited question. I'll jump in on that one there, PJ. But there's definitely a lot of questions about, the timing of the market, what's the future looking like and, how long things are going to last for.
Yeah. Again, it's hard to say when the cycle is going to turn. But what I will say, and I said it a moment ago, is that I will tell you. So you're going to hear from me when it is looking like the data is slowing and the phase transition is beginning to occur. And typically what you'll see is that'll start to show up in certain key data metrics. And then what will happen is I will start to reposition my clients' portfolios, my portfolio, and I'm usually early. I'd rather be, a minute early than 10 minutes late to something like that, notwithstanding the metaphor that I was late to this podcast today. But anyway, I'd rather be a minute early.
I didn't say anything, PJ. I didn't say anything.
I'll throw myself under the bus again, don't worry. But that's looking like it's going to be later this year. So probably third quarter of this year, which means really in our June and July shows. So we'll probably have 2 in June and then maybe 3 in July, depends on how the weeks work out. But in one of those shows, or maybe all of them, I will be almost certainly either reconfirming that we're going to continue to see quad 2 in Australia, or I'll be talking that it's time now to begin to reposition for the phase transition that's coming. And I'll tell you what to buy or what to be selling and what to be buying and owning and underweighting and overweighting, all that stuff.
Yeah,
but not now.
So really what I'm hearing you say is that it's not now. And if you want to know when, you got to keep watching every show that we put out, right? That's
correct. Yes. You'll hear it here first. Hear it here first.
I couldn't agree more, PJ. I couldn't agree more. On Sonia's question in regards to should buy a property now or not, that's a heavily weighted question to your personal circumstance. Is it your own home? Is it investment property? There's lots of things to ask about that we need to delve into. And I'm more than willing to chat to you offline directly on that, Sonia. So hit us up on our Facebook page, which it looks like that you're on there now, and just put an inquiry in and I'll come back to you on that. But in general, the market is looking like there's a lot of room to move because there's all that infrastructure spend, other bits and pieces that we talked about last year that's coming on. And what's going to happen with that is it ends up in the land price. So that's the sort of thing that you need to consider, but it's very much heavily based on your personal circumstances. And we need to we can't just give generic answer that yes, everyone should go buy property when the simple fact is there's a lot more to it than that.
There most certainly
thank you very
is.
much
Yes.
for your question. Yeah, there is. All right.
It's a good question.
All right, we've got
now,
another
one of the
question.
things that I'll just quickly mention, just to
Yeah.
sort of lock off this bubble thing and the reflation trade. You typically get pullbacks and market corrections. And over the last couple of weeks, this happened in January, and then it happened again in February. And during a bout of market volatility, we saw the market come back a bit, a couple of percent. Now, interestingly, I had a couple of questions from clients. They were panicking. Of course, they saw account balances drop, that sort of thing. Of course, I wasn't selling anything, so there weren't any crystallization of any losses or even any gains at that stage. But one of the things I would suggest to anyone who is investing in the stock market or looking for an entry point would be to wait for a day when the market, or even a couple of days when the market has a correction. And one of the things you have to do as a retail investor, if you really want to be professional about this, is you have to be willing, especially if you know the quad we're in. So again, I've just reinforced multiple times here that we're in quad 2 and will be until at least the end of this quarter. So the June timeframe is to take advantage of other people's liquidity events where they have to sell and the market goes down. Use that opportunity to buy. So I actually think today, I've only casually looked at the market today, but I think today we're having a bit of correction in the Australian stock market. So you could nibble a little bit at the Australian market today, buy an index ETF, something like that, and actually begin to build up a position. So don't ever go all or none in a market. You want to sort of phase in and phase out, as it were. So that's one way to sort of even get a bit more pointy about how to now, if you haven't already, now how to get involved in the stock market and the reflation of that stock market.
Yeah, no, that's a good point. I like how you talked about you phase in, phase out. I think that's really important because a lot of people I talk to are either all in, all out, and it's a bit like going to the casino and putting on black.
Yeah, absolutely. And you shouldn't ever do that. I mean, I call it feeding the ducks. So what you want to do is as a position that you might have goes, really in your favor, is you take the opportunity to sell some. Maybe not all of it, because again, if that position has been put on, it's a quad 2 position and it's likely to continue to perform. You feed the ducks, take a little bit off the top, wait till it corrects, either buy it back or prune and plant. So you take a little bit off that, you find something else that's been sold or oversold that you like, and you buy a bit of that. One thing I will say to people, and this happens a lot in Australia, is a lot of punters out there who play the stock market, and it is a game. So don't cancel if you don't like the terminology I'm using, but it is playing a game, and that is don't mess around with all these squirrel hunting penny stocks. I had some guy the other day talk to me or call me about a mining company that was floating. I was like, 5 cents a share, something like that. I'm just like, they had no revenue, they have no income, nothing. And I'm like, why would you buy this thing? So, my cautionary tale is buy stuff that so the big cap players and things like that, the ASX 200 and 300 is a great place to play. And there's plenty of opportunity. There's also plenty of great ETFs that give you exposure to overseas markets. I mean, Asia and the emerging markets is another great market sector to own during a reflation. One of the key things that happens during this particular environment is the US dollar goes down. So guess what, Aussies? Our currency is getting more valuable. So if the borders ever do open and we can get back to the US and other parts of the world to take those holidays, you're going to have more purchasing power, which is awesome. So just bear in mind that, the Australian dollar will continue to inflate and against the US dollar. And that could be a good opportunity to begin buying some U.S. equities and things like that. So anyway, there's a lot of strategies around there. And obviously, if you're interested in any of that stuff, feel free to shout out to Scott, and I'm sure he'll pass my details on.
Yeah, mate, if I can just say anything, if last year's going to linger on anymore this year, what'll happen is that as soon as they open the borders, the Australian dollar is going to drop to 50 cents. And it's just going to be like, ha ha, screw you Aussies, you're stuck down there on your island, and now you can't even buy anything globally. So,
well,
that's
I'll guarantee it won't. I'll guarantee it won't. That is a guarantee. That is something I can promise you that will not happen until we get to
no, that's good.
a
And
quad
look,
three
it's interesting.
environment.
It's really interesting to see what's happening on the dollars front there. We'll probably have to cover that on another show, but that is definitely something to throw some charts up on the show. Another show coming forward is to talk about that stuff because, mate, it's on a run now, and it's pretty amazing what's happening.
Well, again, it's
Look,
quad
PJ,
2. The US dollar always does poorly in quad 2. So again, that's the Aussie dollar is going to continue to have legs.
Well, that's good. And your talk about feeding the ducks is making me hungry, so we're gonna have to call it there.
Awesome. Thanks for having me today.
All right. That's all right. Well, look, thanks, PJ, and thanks for all your information as usual. I love having you on. We'll see you again in a couple of weeks. And today we've been talking about embracing the bubble. And PJ's discussed what the bubble is, what the outlook is for it for the coming year, and also the key indicators to look at on what's going on and when. All right, that's it for me. I'm your host, Scotty North, and today we've been talking all things money, finance, and property, and this is Xenium Live.